Hey everyone, welcome to a brand new episode of In the Money with Amber Kanwar. It's hard to believe it is the end of July. We have been going strong 2 episodes a week for the last 6 months. Well, in August, we have something special in store. Once a week, we are going to be doing our CEO Summer Series. We're going to take a pause on our money manager interviews in August. Don't worry, those will come back in full force in September. But you won't want to miss who we have for you in the month of August. We're going to kick it off with Kevin Strain, the CEO of Sun Life. Then we're going to have Ross Beatty, the chair of Equinox Gold, a man who's done dozens, if not more, gold deals over his 30-plus year career. We're going to talk to David Cassie as well. He is probably one of the most prolific investment bankers on Bay Street. We've also got Bob Dylan. No, not the musician, but this Bob Dylan does have his fans as well. He's the head of Main Street Equity, which is a bit of a cult stock for those interested in real estate. And then we have Michael Cooper. Of course, he is the founder behind all of those dream properties and is never one to hold back on his opinions, either on real estate or on what should happen to our country. These are going to be fascinating, in-depth interviews, so I'm very excited to bring them to you. But for the meantime, it's still July, so we've got a lot of great money manager content for you, including today. Seth Allen is our guest. He's of Cadence Financial Group. He manages just under $1 billion. He's part of Raymond James, and he's got some great insights into stocks that you want to rent and which ones you want to own. Let's get into it. The information provided in this podcast is for informational purposes only and does not constitute financial, investment, or professional advice. The views expressed by the host and the guests are their own and do not necessarily reflect the opinions of any organization or company. The host and guests may maintain positions in any securities discussed on the podcast. Always consult a qualified financial advisor or professional before making any investment decisions. This episode is sponsored by BMO InvestorLine. If you're looking to build a portfolio based on in-depth analysis and a long-term strategy, you understand the power of informed decisions. With BMO InvestorLine, you get access to a wealth of research, market insights, educational resources, including the BMO Investment Learning Center. Start investing today with bmo.com/investorline. Okay, folks, this is a monster week. We might be in the dog days of summer, but this week alone, we have like 40% of the S&P 500 reporting, 30% of the TSX reporting. You have 2 central bank decisions, the Bank of Canada and the Federal Reserve, on the same day. And then we get some tier 1 economic data at the end of the week. This, as the markets right now, as of you're recording this July 28th, are sitting on record highs, both in Canada and the US. We've even got trade deals. We've got breakthroughs between the US and the European Union. Everything seems awesome. Let's ask the experts, though. Is it really awesome? I want to bring in Seth Allen, who's a senior portfolio manager and founder of Cadence Financial Group, which is part of Raymond James. Seth, thank you so much for joining me.
Thank you, Amber. I appreciate it.
I guess that's my first question is everything just awesome as a portfolio manager?
Yeah, well, I think about when we just walked back a few months from today when, quite the opposite was happening in April around the tariff announcements. And, I don't know if I would describe everything as awesome, but yes, we did set numerous new highs last week, and we're walking into what is going to be a busy week, both for companies and for the central bank, particularly in the U.S., to announce kind of their outlook for rates. I don't think we're going to be, the market's expecting a rate cut. But I think the market is expecting some kind of trajectory as to what that's going to look like going into fall next year when it comes to rates, which obviously have an impact on markets themselves.
You invest in Canadian and U.S. large caps. And I'm curious, you mentioned the volatility from a couple of months ago. Shed some insight into your style of investing. Did you remain invested? Were you opportunistic buying the dips? Are you fully invested now? Or are you taking profits? Help us understand how you think about that.
Well, I think anytime you go into any kind of geopolitical event, I think you have to realize that typically these things come and go, and get to a point where you often almost forget about the event itself. I'm not saying that we're forgotten about what's going on with tariffs, and obviously it's top of mind for Canadians, but I think that, this goes back to investment strategy. You need to have one. And I think if you have a good investment strategy, then it lets you know what you need to do going into these type of events. In our case, we own stocks either to rent them or to own them. And we're pretty clear about our strategy on each type of holding. And so what we did in April when we realized that, how should I say it, a lot of the headline stuff probably wasn't going to be as meaningful or impactful as what the market was thinking, we actually used it as an opportunity to add to both rents and owns going in later in April and going into May. So right now, we are sitting on some cash, roughly around 10%. But again, we're looking to put more of that to work as all this tariff headline stuff unfolds.
Can you help me understand the criteria? Like, what's a stock that you rent versus a stock that you own? What are the characteristics?
Well, I use the analogy of housing. So, a stock you rent is maybe something that's a little bit more short-term in nature. It could be cyclical stuff, for example, in the mining sector or energy, are definitely to rent. They're opportunistic, they're tactical. Whereas to own, those are companies that have wide moats, and they're ones that you frankly don't ever want to sell. You may change the amount of the position you have. So, for example, an Apple or an Amazon would be to own, and you may have, different percentages in the portfolio depending on what the outlook is for at that time. But it's one that you want to own for a lifetime, as long as the business itself doesn't change or your reasons for owning it.
Can we think about the market that way too? Like with the market at all-time highs, do you want to rent it here or do you want to own it?
You want to own it, right? I mean, look, we just did a presentation a few weeks ago for clients talking about buying into all-time highs. And the data supports the fact that you actually, if you bought at an all-time high, you typically make more money than just being in the market. So I think that, this idea that you have to be in and out of the market is a dangerous one because, and again, there's been various versions that's floated around in the last year, but, missing a handful of best days in the market, your return drops significantly. And I think that, this is where we're active managers, but we're not day traders and we're not market timers.
I love that. And I've been learning through the, course of doing this podcast. I'm learning to love all-time highs, or don't be afraid to add at all-time highs instead of buying those dogs, which I still do. Everyone knows that's my sort of toxic trait.
I started off my career doing that, right? It's human nature to want to, try to buy the ones that are, either going into the garbage bin, or we think we found a low. It makes us feel good, but the reality is it's just as good to buy stocks when they're breaking out to new all-time highs, because typically when that's happening, there's something fundamental going on with a company that's leading to that breakout.
It's so funny. You said you started out that way. I read something that did you start a business or did you start investing when you were 13?
Yeah, I did have a little side franchise business. It was on the firecracker side of things, and I had groups of kids that would be out there selling and what have you. But I also started my first investment when I was 13 as well in the stock market, which, as it happened, was a positive investment, doubled my money, and I thought this was way easier than paper outs and working as a dishwasher at Red Robin at the time. And but then I quickly learned, it took me a while to learn that the market doesn't always deliver you positive returns.
I feel, I don't know how old you are, but that feels very child of the 80s. A 13-year-old running around selling fireworks, selling fireworks to his friends. So, I mean, it sounds like you're somebody who's always stress testing, like where could you be wrong or where could your mistake be? So as you look at this market, you say it's one that you want to own. Don't be afraid of all-time highs. I think people, they look at a group like the Mag 7, and we're going to talk in detail about certain stocks in the mailbag. But, they look at the fact, okay, the Mag 7 is back. How concerned should we be about things like concentration risk? How do you think about that?
Yeah, I mean, I think it's something you need to be cognizant of. The Mag 7, I don't know what the percentage is exactly of today, but it's roughly 35 to 40% of the S&P is made up of those 7 stocks. People do forget about things like Nortel and BCE that made up 70% of the TSX at one time. I think, though, that what you have to do is take a step back and think about these Mag 7 companies. Some people have used analogies of the Nifty 50, but the difference between those or the .com and today is that these valuations are not eye-watering, generally speaking. And I think that you also have to look at what's driving these valuations and these stock prices. It's this whole artificial intelligence theme, which, in our opinion, is something that's even bigger than the coming of the internet. And I think that we're just starting to, as a public, understand. We're starting to hear more about AI, but I think that it's something that is, again, much bigger than a 1 quarter or 1 year thematic. It's something that, we're going to see probably for a few decades unfold.
And we're going to talk about how you play that in the portfolio. They'll still come up in the mailbag and may come up as well in some of your pro picks. Before we get to the mailbag, Seth, you talked about kind of those early lessons. And, we're really passionate about financial literacy for children over here as well. I'm a mom. I think about how can I get my kids started investing, but I'm also passionate about getting more women involved and investing. I think there's a reality that it's kind of a gender split. I see it in my own audience rankings. More men are listening to this podcast than women. And I think it's a podcast for everybody. And you've got some great initiatives to kind of bring women more into their own when it comes to investing.
Yeah, it's Her Wealth Society that we kind of involved with and volunteer for. There is a upcoming summit that's 100% focused on women. And what it's focused around is women's financial empowerment and betterment. And so the idea is whether you're, a teenager looking to start saving, or you're somebody in your 70s or 80s, maybe you lost your spouse, or you're an entrepreneur and, you've been actively trying to build a business. Now you want to look at your investment side. This conference is there for everyone in terms of touching on various topics that are important to women. And a lot of this was inspired, frankly, by having a single mom raising 3 kids and watching her go through the trials and tribulations as a woman, trying to get a mortgage, dealing with RSPs, negotiating with contractors. And, for one reason or another, I seem to have an inclination for this kind of stuff. And she would bring me into these things. And it astounded me to watch how she was talked to as a woman. And it never really left me. And so I think that doing this initiative or getting involved in it is a way that can, to your point, whether it's your kids or yourself, or even, frankly, there should be more women viewers on your show, how to kind of break down some of those barriers or some of those impediments.
Okay, I love it. Let's get some of these women in the money. Let's go into the mailbag and see if we can find some his and hers investment ideas. Our first question in the mailbag, Seth, is about Cameco. What are your thoughts on uranium and Cameco specifically? This is from Carl in Sudbury. You talked about the AI trade, and it seems like uranium and Cameco has been swept up in that because it's also prompted, resurgence in nuclear. And what do you need nuclear? What's the key input there? It's uranium.
Yeah. First off, we own it in the portfolios. It's a to rent name. Just given the nature of the business that they're in. I think you touched on something that's interesting, that has made some headlines but isn't really fully understood, is the demand for power and where is that going to come from. When you use artificial intelligence to, say, Google for something, the amount of power is between 500 to 1,000% more than just a regular search. And so if you do that math on a large scale, obviously the demand for power is going to be astronomical in the coming years. And how are you going to backfill that? Nuclear, we've all heard the story, why it's great value in uranium for the last 20 years. But the reality is It's really taken a change in sentiment, particularly now starting to view this as a green energy solution. So you see, for example, the UK looking to expand into nuclear. You have this idea of these small nuclear reactors, perhaps taking a hold, in the coming years. And so going back to Cameco, there's not a lot of names to invest in the space that I would say that have, safe geopolitical production. And I say that because most of the uranium is made in places in the world where, there's some geopolitical question marks going on. And with Cameco, of course, not only is it safe, but it's they're a very high grade, low cost producer. So, for them, they're in a perfect sweet spot right now, which is why the stock is trading at, new all time highs.
And 77 times earnings. So when you say it's to rent, what's your catalyst? When do you know the cycle's over?
I think with that one is that, watch uranium price in part. Uranium is the one fuel out of all the fuels that power electricity that the cost doesn't really materially impact the producer. So, I think, we could see, uranium prices double from here and still see the demand for nuclear. You plug that into, a 100% increase in uranium prices into Cameco, and that 77 times earnings doesn't look too expensive. That being said, that's probably a point, if you haven't sold some already, you're probably going to want to.
Okay, those are good markers. Let's stick with the AI related questions. We got a question on Microsoft, which actually reports this week. We've got 4 of the 7 Mag 7 reporting. Microsoft is one of them. Would you add here? It's one of those classic stocks, trading at those record highs. Do you add here?
Yeah. So again, Microsoft's another one that we own, not rent in a portfolio. So we've had varying amounts of Microsoft over the years. I think around the question is, Microsoft going to be the AI winner? I think you have to take a step back and realize AI is much bigger than just one company. No different than the internet is much bigger than just, when the internet came around, it was much bigger than just one company. In terms of Microsoft, again, we don't really believe in holds. It's either a buy or a sell. So, to answer the question rather pointedly, yes, it's a buy. Do you buy before earnings or after? I think you need to figure out, how much of it do you want to own, and perhaps you leg into a position before earnings and afterwards, add to it, whether it's up or down, just because this again is a hallmark name to own in the AI space. Again, look at the growth that they've had with Microsoft Azure. You look at, the OpenAI partnership or the investment, how that's been evolving for Microsoft. And, it's a company that, again, is, I think, one of the kings in the AI space, but it's not the only one.
Let's compare and contrast to Apple, which also reports. And I mean, this one has just been a laggard. It's the second worst performing Mag 7 in 2025 behind Tesla. And everybody wants to know what's the AI strategy. Other companies were looking at, okay, how much are you spending? Where's the ROI? Apple, we're just wondering, have you heard of AI? And what are you going to do with it?
Yeah. So I think a couple of things. Yes, Apple has been a bit of a laggard. Yes, they've been getting a lot of criticism around their AI strategy, but you have to remember, Apple is more of a utility-like stock, albeit it's in technology. It's utility in the sense that once you're in their ecosystem, it's unlikely that you're going to leave it. Any of us that have an iPhone typically use some of the services of Apple. And when you look at the company and the growth of their services business, it's been growing by leaps and bounds over the last several years. And on the AI front, you don't have to be the first mover to be successful. And you think about just use the internet, the timing of the internet in the 90s and 2000 and what happened there. I mean, Google was a late comer, right, to the whole internet boom. And look, Google dominates their space. So I think in terms of Apple, they're well capitalized, have lots of cash on the balance sheet. I think they can afford to wait and wait for the right strategy versus trying to rush out and do a Me Too. when it comes to, we have an AI strategy rollout. That also being said, they recently announced at their developers conference a rollout of some AI in terms of its interactions with the various services. And so, again, I wouldn't really worry about too much in the short run. Again, this is a name we own in the portfolio. And to me,
So
it's
you
a
would
buy.
add on this AI related weakness.
Yeah, I mean, if you don't own it, I would be owning it. Again, how much you own, you may want to wait to see a little bit more that comes out around the AI side of things. But at the end of the day, Apple is another one that you definitely want to own for the long term.
You mentioned it should be more viewed like a utility, like a tech sort of utility. Yeah. One thing that people say, and I'll say, is that, all right, if I'm going to do that, should it be trading at 30 times 30 times earnings versus the utility sector, which trades, well below that it's an expensive stock for the anemic growth?
Yeah, I think though the difference is that they have the ability to supersize that growth either with new product announcements, getting into a more successful AI strategy, expanding their services business. I mean, their services business is a very high margin business, or even just other smaller things, announcing the partnership on the satellite access, right? It could be in the near future that we could all be walking around with a sat phone, which is kind of interesting. So I think that unlike a utility that's sort of fixed in terms of what their business is and what their ability to produce revenues is, I think Apple has that optionality in terms of revenue growth. And again, granted, it's been slow over the last year or two. One other thing which I didn't touch on that we've done a lot is option writing around Apple. So here's one again that we like to own, and we do own. And during this time of, I call it kind of quiet period for Apple in terms of the stock price movement, writing puts and calls around it has been very profitable. So it's a way that you can add value on a position that you want to own for the long term without taking on any additional risk or marginal risk.
Okay, these have been stocks that are generally hot or have some heat around them. We're going to take a quick break and talk about some of my favorite kind of stocks, ones that are in the doghouse, but that maybe have some re-rating potential. We'll be right back after this break. Okay, our next stock in the mailbag is Nutrien. What do you think about Nutrien at these levels? This is fertilizers. And I love this sector. I wonder if you're going to say this is a rent.
Correct, Amber. It is a rent.
I'm getting to know you.
Yeah, it is a rent. It's something that we bought recently. We own it in the portfolio. I do believe it's a buy here. Again, going back to what I said before, we don't believe in holds. That's the easy answer. It's either a buy or sell, and this is definitely a buy. I think there's some underlying dynamics that are driving the fertilizer business. And for Nutrien, they're a beneficiary of it. Some of the conflict in the Middle East recently highlighted the tightness, for example, in the supply of urea, which is a prime ingredient in fertilizer. We have other political tensions happening in other areas of the world that obviously affect potash and what have you. And so the question is how long do you rent it for? Because there is, a certain point where, the price of fertilizer, farmers do kind of do a bit of a switching or do pull back, even though they need it, frankly, to grow food. And so, I look at last time around the Nutrien had a run. It hit around 130 or 135, I think, was the all-time high. So, I think I wouldn't wait till it hits that point, but I would be thinking about, maybe trimming it, somewhere, north of 120.
So it's at 80 now.
Pardon me?
It's at 80 now. And so, that's like a nice chunk of change.
Right. In the meantime, you could write some covered calls and things like that, that could add some extra income. I find for us, covered call writing based on our strategy keeps us disciplined, because nobody's going to tell you the top and Nutrien's happened, particularly on a rentable. And so you need to be, taking some money off the table, as it runs up.
The reason I have a soft spot for this sector is when I first entered the biz, the financial journalism biz, it was right as BHP was taking a run at Potash Corp, which of course Nutrien is a product of potash and agrium, but that was just like, it was so huge and we just covered it. So my first foray into financial journalism, I still have a soft spot for it, was about potash because it unearthed so many complicated questions about, financial security, food security. The government got involved, a foreigner buying. And so it really taught me about the importance of this asset. And the way people talked about it is that people got to eat. People got to eat. You got to feed the world. So this is a must-have, not a like-to-have. And yet you say it's a rental, and the stock has proven it is a rental. It's not something that does well over the long term. It does well over cycles. How do we reconcile? People seem to be trying to sell this stock as like it should be a core holding because you got to feed the world, but it doesn't really behave that way.
Yeah. There's a lot of companies that are involved in feeding the world. So I think the thing with Nutrien is because the dynamics of what drives that share price is based on an underlying commodity that not even Nutrien ultimately controls. And some of it is being driven by geopolitics, which, as you know, you can end up in a blizzard and suddenly you got sunny skies. So I think recognizing that and given that the valuation is driven by the underlying commodity, yes, they do have, full integrated supply chain. So they are selling, directly to farmers and what have you. But the reality of what they're making is commodity driven. It's a rental, right? Now, it doesn't mean that, it peaks at some point and, you see a plethora of potash hit the market because peace, breaks out between Russia and Ukraine. And you don't pick it up at some point tactically when it's gotten very cheap, relatively speaking. It's not the same as a company that is driven by things outside of, a commodity situation.
Let's talk about Disney, because that's not driven by commodities, but it is driven by kind of consumer habits and how much money they've got in their wallet. But also a bunch of structural things that are taking place with cord cutting. Disney just remains, it trades, you can make money. It trades in a range recently in the last 2 years. But it just doesn't seem to be going anywhere like above, call it $120 per share. What do you do with a stock like Disney?
Yeah. So first off, I say everybody likes Mickey Mouse. If you can see some of the things behind me, there's a Mickey Mouse or two on my shelf. But look, I mean, one of the issues with Disney, I think historically they've made some acquisitions maybe that haven't paid off as much as they thought. ESPN comes to mind, but that's really backward looking. You have to look at where the company is sitting right now. The parks, despite that term woke is broke, frankly, are doing very well. In fact, they're having record numbers there. Yes, they're facing some pushback on their price increases and what have you. And you look at the streaming side, which is something that is relatively new for them. I mean, they've come after Netflix. And again, that's become their second, driver of revenue and earnings. They have an entire franchise they bought, whether it be Marvel or Lucasfilms, that they can. I mean, I'm a big Disney fan of all their products, and I look at the fact that the only thing that's limiting Disney, in my opinion, is creativity, and the more creative they get, the more revenue they're going to generate. I.e., whether it's by again from streaming or even on the park side, they're opening up a park in the Middle East, which I think is exciting. It'll be interesting to see what the take is that they have there versus, say, at Disney in the United States. And, in terms of the share price, it has been a massive underperformer if you look at the last 10 years. But again, when you looked at the stock recently trading down in the 90s or high 80s, that's roughly around the same price it was trading at during COVID when everything was shut down. And so, for us, Disney is a to own name. We did scale back our Disney and had a very small position in it, but then we added to it when we started seeing some of these things change for the company, particularly around their streaming business, and just seeing the park business wasn't as bad off as, quote, the headlines were making one think. And so, if anything now, I think, again, Disney earnings will be coming out here shortly, but I wouldn't be surprised seeing this stock break out to new highs.
All right. Well, I love that because with a market that is trading the way it is at, heavier multiples, this one's trading at a discount to the market, maybe for fair reason, but maybe that's where some of the opportunity lies. Let's move on to two Canadian ones. The first one is Canadian Apartment REIT. So, a lot of catalysts in apartments for a time with immigration, rent growth was very high. And now all of that seems to be kind of undoing a little bit. How do you think about your exposure here?
Yeah. So Canadian Apartment REIT is one that we own. We've had it in varying amounts over the years. It's in the REIT space. We're not overweight REITs currently in our portfolios. Canadian Apartment REIT, it's a simple business. Obviously, it's a multifamily rental. I think that the stock probably bottomed out here recently, kind of in the high 30s, low 40s. We added more to it recently after the InterRent deal, where we saw that company sell for roughly around NAV or a 5% discount to NAV. And if you look at the net asset value or NAV of Canadian Apartment REIT, again, it depends on which analysts and which calculation you use, but it's somewhere between 15 to 25% discount to NAV. And so I think that it's cheap based on just that recent transaction, let alone the fact that they're in a space that is, it's one of the things that the last election was about, was housing, right? And it will be interesting. I think one of the surprise upside could be is if this current government does something a little bit more innovative that really is a win-win, both for companies like Canadian Apartment REITs, but also for people, frankly, trying to find affordable housing. So I think at this level, it is good to own, and I think that it's I think that it's good to own, and where it goes from here, I think is really going to be dependent upon what we see happen, policy-wise when it comes to the housing market, and to some degree, interest rates in Canada.
You mentioned that InterRent deal and that it went for, they were able to buy it for around a 5% discount to the net asset value. I saw some analysts commenting about how that was a bit of a surprise, that there was no other bidder who came in. And typically in the past, transactions go for a bit of a premium, especially InterRent was not in any real distress. What did that tell you about kind of the vibes out there when it comes to real estate?
Well, I think one of the issues is what is the net asset value truly? What is it truly? And we haven't seen a lot of transactions on a large scale, whether it be in office or residential, to kind of prove up or show up those NAVs are correct. And so in the case of, InterRent, whether that was a correct NAV that it was kind of bought off of, or maybe the NAV should have been a bit lower, at the end of the day, the market transaction got done. And that's why I go back to Canadian Apartment REIT. When I mentioned that, the range is 15 to 25% discount to NAV, it really depends on what the value you put on that real estate. And again, we just haven't seen enough transactions on that front. I also think, too, that there are some funds and pension plans that might be real estate heavy, not looking to add, but looking to offload. So perhaps some of the buyers you normally would have seen in the market just weren't there just because they were, they had their fill, so to speak, of real estate.
A final question here. Speaking of M&A, CP Rail is a question that we have. Where do you think the stock will be in 5 years, if you have that kind of prognostication? But there seems to be, M&A seems to be alive in the rail space under the Trump administration, not involving CP Rail, but it could affect CP Rail if there's a bigger, kind of more consolidated player. How do you think about CP Rail in isolation and with what's currently going on in the landscape?
Yeah, I think the rails are like pipelines. You don't see a lot of them, either get created or built. I think CP, is has a business line that touches all parts of North America and into Mexico. In terms of where do I see the stock price in 5 years? It is a stock that we own, not rent in the portfolio. And so as I see it, CP is going to be higher in 5 years than it is today. If we look at the last 5 years or so, the stock has gone from 70 to roughly 105. The last couple of years, it's moved sideways in part because of the recent acquisition that they completed. And, probably a little bit of sentiment around the tariff issues going on. But at the end of the day, CP moves stuff, right? Whether it be, grains or products or things and what have you. And I think that, again, I compare it to pipelines. When was the last time a brand new rail line was built? I honestly can't tell you. I mean, I think it's been decades, right?
CP Rail kind of got it across the goal line when it bought Kansas City, and there was questions at the time if they were going to be able to. Ultimately, they were. Now you have, Union Pacific potentially buying Norfolk Southern, CSX retaining people to look at its own M&A options, BNSF that might sort of get involved with that as well. Does any of this matter for CP Rail? As a standalone, I've heard people talk about how maybe it's a net negative for like a CN Rail. Have you thought about how consolidation and some of its peers affects?
I mean, it's like seeing consolidation of pipeline space, right? Again, I go back to when was the last time an actual rail line was laid? I don't think any of us can recall or know. And so, I go back to CP. Yes, they may face certain competition on some of their rail space in the United States. But at the end of the day, we're seeing fewer names, our names get consolidated into fewer names. And, unless we suddenly start seeing, new rail being laid, I don't really think this is an issue for CP in the next 5 years.
Okay, great context on some of our mailbag stocks. Now it's time for a look at Seth's Pro Picks. Pro Picks is brought to you by ATB Financial. With $62 billion in assets, ATB Financial is powering possibilities for more than 820,000 financial services clients in Alberta and beyond. ATB's capital markets arm is a full-service investment dealer that offers investment and corporate banking, sales and trading, institutional research, and risk management. Visit atb.com/inthemoney for more information. Okay, all of these pro picks, they seem like they're in totally different industries. So I'm curious, before we get into it, Seth, do they have a theme?
Yes, they're all artificial intelligence themed, and it's something that we believe is not a 1 quarter or 1 year thematic. We believe that AI is a multi-year, even multi-decade thematic to invest in.
But they're not the obvious sort of Mag 7 AI-driven names or even the semiconductors. So let's go through them and you can help us explain why AI is actually a driver of the shares. We'll start maybe with Intact Financial, Canadian insurance company, property and casualty. It's done quite well as a stock. I don't think because of AI, but you have it as a pick partly for that reason. Tell me why.
Yeah, so interesting enough with Intact, you're right, it's done quite well. It's actually outperformed the TSX this year and it's outperformed the TSX over the last several years. And it's been a quiet name that nobody's really talking about. We do own in the portfolio. It's a to-own name, not a rentable. And I think the AI side of this is, you got a company that is number one in this country when it comes to property and casualty insurance. And they're using artificial intelligence to help them price risk. And, one of our mantras with Cadence is, it's about managing the risk, not the returns that matters. And by the way, that's not our first thought. That came from Benjamin Graham. And so I thought it was interesting that the fact that Intact has embraced artificial intelligence as much as they have, and as much as it's not apparent when you first look at the company because their business is insurance, but really what their business is about managing risk. And if you can use AI to help you do that, that really gives you a leg up and adds to your profitability.
And do you have, like, because you've been following the company, do you have, are they seeing dividends in that now, like in your communications with the company and how you track that? Or are you just taking comfort in the fact that, they're at least open, they're embracing, they're testing different ways to deploy it?
Yeah, I mean, they're not going to share with anybody their proprietary AI algorithms and what have you, but I think it shows up in their earnings and more importantly, their share price. There's a reason why their share prices outperform the TSX. It's not just, because they're an insurance company.
We talked about uranium as a way to play AI, kind of that fuel, the energy that these hungry data servers need to power AI. Your second pick, it's not uranium, but it is an energy producer, EQT Corp, also done really well. Natural gas, right? Supplier of natural gas.
Well, first off, how's it connected to AI? First off is that AI needs a lot of power to drive that, that space. And I mentioned earlier on the show that, a simple, if I Googled your name today, I would use a certain amount of power. If I used AI to do it, I'd use 500 to 1,000% times more power. And if you expand that out, we need a lot of power, to help supply this upcoming, as AI becomes more integrated into our everyday life. And so you look at EQT, they have a couple of things going for them. You got the expansion of LNG, you have the switching from coal to natural gas happening more in the United States. And of course, you got the whole AI boom and the electrical demand needs. The other thing that they've done is they've also acquired natural gas storage. So anybody that's followed natural gas stocks, it's a thing where gas prices obviously go up and down and are quite volatile. Well, here's a company that can start storing gas when gas is really cheap. And, all we have to do is think back to COVID when we saw negative oil prices, for example, and we marveled at, geez, if I just had a place to store that oil, I can buy it, I can have somebody pay me to buy the oil. And so with EQT, the fact that they do have storage capacity, again, gives them an ability to kind of smooth out their revenues, particularly around the cycle of natural gas prices. And so, the stame's to rent still, because I think that their business is still driven by natural gas pricing. But as we look forward, it could be a to-own business, particularly if they acquire more storage capacity, because then that would give them an ability to really smooth out earnings and not be affected by that volatility in the commodity.
I mean, its ability to divorce itself from nat gas prices is actually quite impressive. Year to date, nat gas is down 40% and EQT is up 12%. Like, maybe not amazing returns compared to, what you could get in the Mag 7, but the fact that it is beholden to nat gas and can outperform like that, that says something.
Yeah, and just to clarify, I wouldn't say they fully divorce themselves in nat gas prices, but they are divorcing. So they're in the process of that. And, if we had this call a week ago, the stock, was about 15% higher. We actually just added to it in the portfolio. And so again, this is a name to rent at this point, but we do think it's a buy here.
So your third one maybe is a little bit more of an obvious AI play. That's Uber. And I guess the question is, how do you see AI driving that next leg of growth for Uber? Because it is already trading, close to those records.
Yeah. So again, this is a company that I think is going through a bit of a transformation and a recognition of just how big their market is. So, when Uber first came out, it was rideshare, right? Call an Uber versus having to wait for a taxi. And that was interesting and what have you. But I think what's more interesting with the company is the realization that they're market, the size of the market is much, much bigger than I think people realize. So you have ride sharing as a starting point. That's about $1 trillion market. You have food delivery services, which is about another $1 trillion market. And then you have freight services, which is about another $800 billion to $1 trillion market. So you have a $3 trillion market that Uber can tap into. And how that future is looking is through AI, and more specifically through AI-driven vehicles, right? And we're already seeing the test cases in San Francisco and Austin. I just saw in Las Vegas, they're also going to be, or they have been testing these automated vehicles. And some people have pushed back about, well, geez, what if these things get in an accident? These things are, automated. What if somebody gets hurt? Well, all you have to do is look at, road statistics. There's accidents every day. And I would surmise that there'll probably be a lot fewer, if any, eventually, once we have fully automated cars driving. And so going back to Uber and their expansion strategy, they're indifferent to the AI software. They're testing out, Google software, for example. They're indifferent to the cars, so they have different vehicles, whether it be Teslas or other ones. And so, at some point, we're going to see, maybe it's 2 years, 3 years from now. Don't be surprised that your courier service is an Uber, or the trucking service is some kind of Uber that's moving a product or service. And again, this is an interesting company too, because it's not really affected by tariffs in the sense that they don't really export anything or import anything.
That's great perspective. And I think even with tariffs kind of settling down, investors will probably want some of those non-tariff affected ideas. It has been such a pleasure to speak with you, Seth. Thank you so much for joining us on the show and spending time with us.
Yeah, thank you, Amber. I appreciate you inviting me.
Make sure you tune into our next episode. We are talking all about real estate with one of the biggest real estate investors in this country. We've got Michael Masagi of Arch Capital joining us. You can send us your questions about REITs. Email us questions@inthemoneypod.com, or you can find us anywhere on social media @inthemoneypod. And we'll see you on the next episode.